everyone, and welcome to Before the Sale. This is a presentation about tax-savvy approach to liquidity events. I'm Haleh Moddasser, Managing Partner at Stearns Financial Group, and I'm fortunate to be joined by Paige Otos today of Lanigan Ryan. Paige, welcome.
Thank you, Holly, for having me, and I'm very excited to be part of this presentation as well. I am a CPA and a tax director at Lanigan Ryan. Our firm is based out of the DC metro area, and we are moving our way into the North Carolina market, and I'm based out of North Carolina. So happy to be here.
Delighted to have you. I should mention to our audience that I'm a recovering CPA back in the day, which is why Paige and I work so well together. Our presentation today is going to focus on not just what you make from your liquidity event, but how much you get to keep of that. And why is this important? I know you'll attest to this, Paige, but oftentimes clients come to us after the event is over. They show up with their CPA and a shoebox full of receipts, and the only thing there is to do most of the time at that time is just to do the compliance work. There's no way to save the tax dollars if you wait till that point of the following year, typically. Would you agree with that, Paige?
That is completely correct. Even before the sale occurs, planning needs to start happening to be prepared. So.
So let me just be clear that there are multiple ways that Paige works with clients on saving tax dollars. You can do everything from donate to a 401k or a charity, contribute to a 401k or a charity. Um, Tonight's presentation is going to focus on the intersection of investment management and tax code. And so what I mean by that is actually using investments to lower the tax burden. We believe that having two disciplines results in a smarter outcome. Paige, talk to us about this.
Yes, every investment decision that you make does have some sort of a tax impact. And so it's making sure that we're planning for both. You want to have a good high investment that's performing well, but then also how does it going to impact your taxes? So it's working those things together. And that's where Holly and I work well together is that, it's the CPA and her investment advisory can kind of come together to create a nice holistic approach and help our clients meet their overall arching goal, which is for their portfolio to grow and to be able to fund their lifestyle and what their dreams are.
That's right. And so just want to preface all of this by saying that we're never going to let the tax tail wag the economic dog. So the most important thing for us is that whatever investment we make is an appropriate size relative to your overall portfolio. It's in the right risk tolerance and it provides the liquidity that you need to fund your retirement expenses. With that said, there are often opportunities to save tax dollars, which enhances that outcome. And so let's talk about how these gains are generally created, Paige.
Yeah, so these gains are created usually by the sale of land or real estate. This could be like your primary residence if you've lived there for a long time, a vacation home that's appreciated. It could also be that you were an investor in a partnership, like for an apartment complex or commercial that has grown over time. So that's one aspect of it. A sale of a business. So you end up selling your business, you've had it for a long time. That's going to trigger a gain, and it might trigger a couple different types of gains, and those are things that we'll talk about next. But that is something that is a huge taxable event that when that does occur, as well as sale of concentrated stock. We are located in the RTP. A lot of people receive stock options as part of their compensation. Sometimes they sell it automatically, other times they exercise it and they let it grow. And as the company becomes more profitable, that concentration even becomes even greater. So that's one aspect of a concentrated stock.
And we've also seen situations where, a child receives a gift of one share of a stock.
Yeah.
They've now had it in their portfolio for 50 or 60 years, and the embedded gains are just huge. Makes up too big of a portion of their overall portfolio. So we have to figure out ways to reduce that concentrated stock position without spending 30% of it in tax dollars. And so that's another area that we can focus on for clients. So let's talk a little bit about what it is you're selling and how it's taxed, because there are different types of tax brackets for different types of gains depending on how they're categorized.
That's correct. So short term versus long term, that's a big sticking point. A lot of times people think gains are just gains. So short term gains are taxed at your ordinary tax rates. So for the highest right now, the highest federal tax rate is 37%, whereas the highest long term capital gains rate is 20%. So that's a 17% difference just by holding it 1 year, which is short term is 1 year or less or long term, which is a year or more, and that makes a 17% difference.
I guess we could also just point out to our audience that not every state recognizes capital gains rates. So we're talking about federal tax rates here, but I know, for example, in North Carolina does not recognize the capital gains rate. However, our income tax is so low, it's 3.9%. So we're happy with that. But just to be clear, if you live in New York or California, state taxes can be huge. The capital gains tax would be taxed at ordinary income tax rates, and it's not pleasant.
Yeah, I mean, that's something that just happened in the state of Maryland, where my firm is based out of. And what it is right now is you have your state rate, you have a local rate, and then on top of it, you have a 2% capital gains tax rate. So it brings your tax rate overall to a much higher threshold.
And then we've got ordinary income due to sales. So I know we've got lots of clients who sell their businesses in time, let's say for retirement, or they get an offer that they can't refuse and they suddenly sell. They all think it's always capital gains income, but you really have to check the fine print of the contract because there's different ways to structure these deals. Some result in ordinary income tax, some in capital gains. So, Paige, why don't you explain to our audience how that those different types of income streams are generated?
Yeah, so as Holly mentioned, you want to read the fine print of what the contract is stating because when you sell your business, it can be either an asset sale or it can be a stock sale. So when it's a stock sale, it is treated as if you're selling stock, so it would then be the long-term capital gains. If it's an asset sale, it's going to actually come down to the type of asset that is being sold. So if you have you provided services to your client and they haven't paid you yet, you have accounts receivable. That would be taxed at ordinary tax rates. If you sell inventory, you're a retail store and you have inventory, the sale of that inventory would be taxed at ordinary tax rates. The sale of equipment, if there's any sort of depreciation, we'll go into that in the next section, but depreciation's taxed one way, and then any increase over that would be capital gains. So there's different models, but when you have an asset sale, the only true portion that would be treated as a capital gains would be if you sold goodwill. And that's usually any remainder, that's the unknown factor, because what they look at is this is the purchase price, and then they subtract out the AR, the accounts receivable, the inventory, less the equipment, and whatever's left over is the goodwill portion.
Now, Paige, you were telling me about a client recently who negotiated a sales price. It was going to be a stock sale. The buyer suddenly came to them with a quick little election. They didn't think it was a big deal. The seller signed the election and come to find out it converted it from a stock sale to an asset sale. What kind of impact did that have on your client?
Well, it completely changed the structure of the sale. So now she has gain, and she had also capital losses or 1231 losses, which can be recaptured. So it just changes the mechanism of how it was supposed to be. She was expecting this to not be a huge taxable event, and it completely shifted it to be more taxable. And unfortunately, now lawyers are involved because that wasn't what was agreed to in the contract, and then it got changed when the tax returns were being filed.
Yeah,
So
so it can be really ugly. Just
it
a
can.
reminder to all that you should never sign anything without going through your attorney, your
Mhm.
CPA, your advisor. The way that these things are structured actually has a huge impact on what you get to keep. The other thing that we've noticed is we have lots of clients that have rental properties or commercial properties. They know that, let's say they bought it for 500,000 and now it's worth 2 million. They assume that their gain is 1.5 million on that because they forget that annually, every year, Paige has depreciated that asset. Now, what that did while she's done that is lower the tax due on your rental income, which means you're saving tax dollars at ordinary income tax rates. But at the end, when you sell that property, your basis is now lower, so your gain is bigger. Talk about how that depreciation recapture works, Paige, if you would.
Yeah, so specifically with real estate, how it is that that depreciation, if the gain is exceeds that or is even part of it, you have to recapture the depreciation and it's a flat 25%. It's called 1250 gain. So that is something just to be mindful of. But 25% gain rate is still better than 37%. It's not as preferential as that 20%, but it's you still get to have that benefit.
And just for those of you out in the audience who are like, why did I depreciate? You're essentially converting ordinary income into a lower tax rate at the end. Again, you would have been taxed at 30% on the rental that wasn't lower due to depreciation. At the end, you're paying a 25% tax. So you're saving 12% in taxes over that transaction. But you still have to recapture that. And I think a lot of people forget how big that gain is at the end.
Yeah, and sometimes people like, as Holly kind of alluded to, some people are like, I don't want to take depreciation, I'll just forget about it. And the IRS knows people do that. And when you do calculate the gain, if you had not historically taken depreciation, you still have to factor it in because that was your choice. That's not the law. So they'll make you go back and pay tax on that as if you had taken depreciation when you really didn't. So you definitely want to take depreciation.
Yeah, because it helps you all along while you're doing that. So it's definitely advantageous, and you're going to be forced to recapture that at the end regardless.
Yeah.
Federal and state taxes, we talked about a little already, is that not every state recognizes capital gains, and some actually it might be punitive. And so it's very important what state you're located in and what the state impact might be. But generally speaking, the federal tax is the one that would be the highest rate. And so getting a discount federally for capital gains is highly advantageous. Let's talk a little bit about the pre-sale structuring because as I mentioned earlier, people show up, they're like, oh, I just sold my business. There's nothing we can do at that time. I mean, you've already got a contract, you may already have the proceeds. It's very hard then to plan for tax reduction at that point. So, Paige, talk a little bit about pre-sale structuring. What does that mean exactly?
Well, it can mean a lot of different things. So sometimes it's deciding who's going to want to buy your company and what are they going to want to buy. Are they going to want to buy, take over your contracts? You may want to have your company set up a certain way to where it's very easy for them just to assume your contracts. If they're selling, if you're buying, I'm sorry, if you are selling real estate and it's owned by multiple people within an LLC, and let's just say one of you wants to take advantage of one of these strategies we're going to be talking to you about, but the others don't, you may want to go ahead and pursue a drop and swap, which is where it converts from being an LLC to where you all own it as tenants in common. So that allows you more flexibility with how you want to utilize your proceeds and how to invest them in the future.
Now, these are real life examples, but we've got lots of people in Eastern North Carolina with land. They're in family limited partnerships. So there are multiple siblings that own them. You know, some of these are you sell the property for $20 million,
Mhm.
$15 million, and it's divided by three siblings. One sibling wants to roll it over into a 1031, the other two don't. That sibling has no options if it's in the LLC, though the point here being before the sale occurs, as far back as you can, you should just convert the LLC structure into tenants in common, which allows each of you to do what you want with the proceeds. So if one of you wants to take the proceeds, pay the taxes, you need the liquidity, now you have the asset. The other one doesn't need the liquidity, doesn't want to pay the taxes, wants to roll it over, they get to do that as well. So that's a very important pre-sale consideration.
Yeah.
So this one pretty much describes how most people feel about this. We have four strategies we're going to go over this afternoon, and it's hard to know whether you should employ one, two, whether you should stack them. Most people don't employ all of them just due to circumstance. However, we're going to go through an actual case study where, for the purposes of this presentation, we're making this client invoke all four strategies so that you can understand how it actually works and what kind of money we're talking about saving. The first one is asset location. And so, what does that mean? This means that from the get-go, you bring over investment dollars. This might be before you sell your house, before you sell any commercial properties, before you sell your business, but you have your own portfolio. And we're going to put growth assets in non-retirement accounts. So why is that? Because if you have one of the Mag 7 and it's gone through the roof, and we expect it to go through the roof over the long term, we want capital gains treatment on that, which again is 20% federal instead of 37%. If we put that in your IRA, what happens? You don't get capital gains treatment on that. Every dollar that's invested in an IRA, when you start withdrawing it, is taxed at ordinary income tax rates. So you wouldn't want to put a growth assets inside of your IRA if you have that option. Now, some clients only have retirement monies, then we're going to do it. But if you have the option, you want those growth assets to be located outside of your retirement assets. And so then you might ask, well, why would anyone put anything in their retirement assets? And there are really good reasons for this. Some investments throw off interest income or rental income that's not depreciable. So if you're getting pure income, generally interest income, let's say you've got some sort of a loan structure within one of your investments, maybe it's a middle market lending fund, that is taxed at ordinary income tax rates, and it's punitive if it's in an after-tax account. But when you put it in your retirement account, you don't pay taxes on that income that's earned until you start withdrawing from your IRA. For most of our audience, somewhere between ages 73 and 75, and then only in small little increments as you take your required minimum distributions. So it's far more effective to put, interest-bearing investments into retirement accounts because you get that income and it's not taxed immediately. So you're growing your assets at that higher base, at that pre-tax base. So these are the considerations that we automatically would take into account when investing a general portfolio if we have the option. Um, the other thing that we do is a tax loss harvesting strategy. And this is different than when your advisor at the end of the year says, we've taken this many gains, let's sell a few losers and and offset those gains. Because when they do that, you're actually taking an economic loss by selling those losers at year end. This strategy is generating tax losses algorithmically. It's a fund manager that does this. There's no economic loss. And you might say, how do you generate a tax loss without an economic loss? So I'm going to try to simplify and give you an example. Generally, people who are investing in the stock market might buy an ETF. So that's a basket of stocks that's bundled together. And let's say that's the Russell 1000. So there's 1,000 stocks in one unit that you're buying. What this manager does is instead of buying the 1,000 stocks in one bucket, they buy 700 of those 1,000 stocks individually. And again, I'm simplifying. So you might say, well, why are they buying 700 instead of 1,000? That's because they want 300 of those stocks to not be in the portfolio so that, and I'm going to use the example of Exxon and Chevron. Let's say the price of oil tanks, okay? Chevron and Exxon both tank. You own Exxon, you bought it at 100, it's now at 80. You sell it and you have a $20 loss. Immediately you go buy Chevron, also at 80. Remember, you didn't own that. So now you get to ride Chevron back up when the price of oil goes back up. But what you've done is you've generated a tax loss of $20 by selling Exxon, not an economic loss because you bought Chevron at the same price and it gets to go back up. And so you actually are not generating an economic loss, but you've now generated a tax loss. And this is hugely valuable. So if you know you've got real estate property, concentrated stock positions, a business you plan to sell, the sooner you get into this strategy, the better, because the more volatility there is in the stock market, the more money you're going to make here. I can give you an example. We had a client who sold a business for several million dollars. It happened in 2020, right before the pandemic. And as you all remember, the stock market sort of tanked for several months during the pandemic and then rebounded by the end of the year. This client generated something like $350,000 of tax losses. By the way, those are you can carry those forward indefinitely. So he was able to use those tax losses when it came time to recognize the gain on the sale of the business. And Paige, I know you've seen this in action. Talk to us a little bit of how this works on the tax side.
Yeah, I mean, these losses, as Holly mentioned, they get carried forward indefinitely. But what it is, every when we get the 1099 at the end of the year, this 1099 is huge because of all the individual stocks that are held. And so every single loss that is occurring is being reported. I've seen clients that have sold something and they didn't have much time, but they needed to be able to utilize this. And Holly and her team have actually invested them into this fund and it has created losses to help offset their gain. So I've seen this across the board with multiple different clients and it's definitely has helped immensely.
It might be ironic, but most of our clients panic when the market goes down, and the ones that are in this strategy are kind of doing somersaults because they're
Yeah.
generating tax losses with confidence that the market will rebound ultimately,
Yeah.
right? And so it's a really terrific strategy. We're going to employ it in our case study, and you'll see how it works. The third strategy that we employ is something called the Opportunity Zone Fund. This is a way to take a gain, and it doesn't matter what the gain is. It could be from the sale of a business, it could be from the sale of stock. But what you're doing is taking the gain piece only, not the basis. You don't invest the basis. So if you have $1 million um, cost basis and you sell something for 1.5 million, you've got a $500,000 gain. You take just the gain of the 500,000, you invest it in something called an opportunity zone fund. Just to step back a moment, this concept was first introduced in 2017 by the first Trump tax bill, and has recently been updated by the One Beautiful Bill Act. And so what it is the IRS designates, or the government designates, certain economically depressed areas as opportunity zones, and they actually just believe that the private developer is in a better position to revitalize those areas than the US government. So what do? They give high net worth individuals the opportunity to save tax dollars and invest them in these funds where then the developer goes out and actually redeploys the capital into these depressed areas. So the investor gets a tax break and then they get a return on the investment. Hopefully, the area is revitalized and now thriving, and the developer is obviously making money too. So, this is the general concept of it for our clients. In the year that you have the gain, you take that $500,000 gain and it defers you paying taxes on it for 5 years. So, what does that mean? You get 5 years of growth on the taxes that would have gone to the IRS in this fund. That in itself is tremendous. In year five, your capital gain is reduced by 10%. So now your capital gain, instead of being 500,000, just became 450,000. So you get a little tax break there. And that is when the money is due to the IRS. Remember, you're still invested in this fund. If you keep the assets there for 10 years, and this is the real beauty of this fund, remember you invested 500 in it. If it's worth $1 million at the end of year 10, you don't pay any taxes ever on the gain in this fund. So it's not a deferral and it's not a reduction. It's a complete avoidance of taxes. It's for those people that can employ this strategy, it's brilliant. Now, the caveat here is in 2017, when this was enacted, some of the opportunity zone funds were considered real boondoggles. For example, college towns are typically considered depressed economically because you've got students primarily on campus and colleges are not for profits. However, Franklin Street was an opportunity zone fund, and it's not that anybody thinks that Franklin Street couldn't make money. Our understanding is that the opportunity zones will be redistricted for this new legislation, and which actually goes into effect in 2017. But if you have a sale that occurs in July of 2026 or later, you have 180 days to make that decision so you can actually qualify for this. Our understanding is that they're going to be redistricting these opportunity zone funds. So we as investment managers will definitely be looking to see what is the actual risk in these opportunity zone funds. Assuming that you can afford it and the risk is acceptable, the tax benefits are just enormous. And so that's something that we will also employ in our case study. Paige, let me know if I left anything out. I think I covered it.
I think you covered everything well. And yeah, like you said, if you have the funds available, this would be a great strategy to employ.
Yeah, and just to reiterate, you only have to invest the gain here. That's the only piece that qualifies. So if you sell something for 1.5 million, the gain is 500, you get to pocket the $1 million and there's no tax on that piece. But the 500 in an optimal situation is illiquid for 10 years. So you definitely have to have the ability to be illiquid on that piece for 10 years.
Mhm.
So the next strategy we're going to talk about is a 1031 exchange fund. I want to just emphasize the word fund here. Most real estate investors are familiar with a 1031 exchange. So that's where you take your rental property, you sell it at a profit, and then you reinvest it into another property. And by doing that, you avoid the taxes on it. The issue with that is it's not geographically diversified and it requires your active management indefinitely, right? And so you just keep rolling it over. You're still a landlord. You still have to fix the pipes. You still have to do all of the stuff that you do, right? And so the exchange fund is different from that in that you sell your property, you put it ultimately into this fund that's geographically diversified and you go from being an active manager of real estate to a passive manager of real estate, and you also get an income stream from this. I should have mentioned that the Opportunity Zone Fund, there's not really an income distribution from that. That's all about tax savings and appreciation. This fund is more about income generation. It's highly effective diversifier. It gets you out of active management to passive, and it can also apply to land. So you don't have to be, if it's unproductive land that's just sitting there in your family, not earning anything, and you can't sell it because if you sell it, you're going to have a massive gain, that qualifies for this. So I want you to keep in mind as we go through this example. We've got some people in Eastern North Carolina that literally have 10, 15, 20 million dollars of non-productive land that's been in the family for generations. They know if they sell a $20 million property, it's immediately, what is that, Paige? $6 million in capital gains tax to the federal government. They don't want to do that, obviously. They hold on to this land until their death, at which point the basis goes up to fair market value. Then the children can sell it with no gain, and they actually can pocket $20 million. Now, that's Sounds great in theory, except if you're 60 years old, you might be waiting 40 years to do that, and you're not getting any income from this property either. So it's just sitting there. We have some people actually who are sitting on properties like this that are quite cash poor, but have a lot of assets in real estate. So what this allows you to do is today, my 60-year-old landowner can go sell the property, cannot take possession of the proceeds at closing. For that, we have to hire a qualified intermediary. They take possession of the cash. You have 45 days from then to decide what you're going to reinvest it into. And at that point, we perform a 1031 exchange into a Delaware statutory trust. So that's the middle box. You put your money in there, let's say it's $20 million, you're guaranteed 4.5% in income for 2 to 3 years. It then upreates into a 1031 fund that's globally diversified. The Delaware Statutory Trust typically only has, let's say, two to three properties in it. Once it goes into the uprate, is what we call it, and that's the far right box. That's where you're in the globally diversified fund, which fully leased up. You're, 30, 40, 50 properties in the fund, and that is going to pay 6% a year. So imagine you took this land, you didn't have the tax hit, you getting paid 6% a year for the next 40 years. When you die, your kids still get a step up in basis. They can get out of the fund with no tax impact. But you've made all that money all along the way. Paige, anything to add here?
I would just say, like you mentioned, this is a great alternative. A lot of clients I know of mine, they're trying to find, they want to do a 1031 exchange. It's now trying to find a property that they would want to actually invest in. And this is a great alternative. And like you said, you don't have to manage it anymore, which a lot of people don't want to. If you have one eviction that you ever have to go through, you want to get as far away from real estate as possible. So this is a great alternative.
Yeah, it's a little like a boat. They're like the second happiest day of your life is when you buy one, but the first happiest day is when you sell
Is
it.
that one? Yeah.
And so sometimes we have these people with land or multiple properties they've managed for the last 30 years. They're just dying to get out of this and continue to generate an income without ever paying the capital gains tax. And this allows you to do that.
Mhm.
So we're now going to try to employ these quickly into this example of Jim and Allison Johnson. As I said, most people aren't going to employ all four strategies, but for illustrative purposes, we're doing that in this example so that you can see what the potential here is in terms of tax savings. And I want to reiterate this again. The first thing we're going to look at is the top of the pyramid, which is what is your situation? Do you need liquidity? What is your risk tolerance? What is the concentration that you already have in real estate in your portfolio, for example, before we make a decision to do a 1031 exchange fund or an opportunity zone fund, both of which are real estate funds. So, looking at the big picture is the most important thing we do in addition to talking about your goals and dreams. Maybe you're happy to pay the taxes because you want the liquidity because you don't have a long life expectancy and you just want to enjoy yourself. That's a huge consideration here. We then look at your overall allocation. So we're going to look at Jim and Allison's allocation and see how much do they have separately in their portfolio. And at the end, once we're all said and done, what is their final allocation going to be and is it acceptable? We don't want to create concentration risk inside of the portfolio when you have an opportunity to reallocate and have a more diversified and therefore safer portfolio. So the last thing we're going to look at is once those two top criteria are met, are there tax strategies that we can employ? And that's what we're going to focus on here in this case study. So we can already look to the pie chart on the left and see that Jim and Allison have what 44% of their overall net worth tied up in two assets, their business and their real estate. And it's That's a lot of risk. I mean, in the day and age of AI, their business potentially could become worthless overnight. With rental real estate, we've seen situations, just with our recent real estate downturn. If you have just one property and it happens to be in the wrong location and your estate with net outflows, that property might not be fully leasable. And so we saw that during COVID with office space. I mean, none of these things are guaranteed, and we've seen that with stocks in the past. So we want to diversify this portfolio overall. Jim and Allison have a net worth of $8 million. Their portfolio is worth 4.5. They've got a $2 million business. They've got real estate of 1.5 million. The most important consideration for us today is that both the business and the real estate have embedded gains of $2 million. So just on the federal level, $2 million taxed at 20%, 400,000 in taxes. Am I doing the math right there,
That's
Paige?
right.
Yeah,
Yep.
yeah. So that is what we're trying to save, and you'll see in our example that we actually save that, but even more because of the secondary effects of the Opportunity Zone Fund. So the first thing that we do, and you do this as soon as you can before there's a sale. In this example, we're assuming that Jim and Allison went into the tax loss harvesting strategy in 2020 and they sold their business in January of 2025. So these are real numbers. They invested $1.3 million into this strategy, and by the end of that 5 year period, they generated $506,000 of tax assets. Again, Paige, that they can roll that over indefinitely, and you've gotten that information from their 1099s. Is that correct?
That's correct.
And so you're reporting it annually and just carrying it forward on their tax return, kind of waiting for this liquidity event to occur.
Yeah, and it will off, I mean, and even in a regular year, there's going to be some income, there's going to be some capital gain distribution. So it'll be utilized every year to a certain degree, but the purpose of this is to be able to be available when you do have a large event that does occur.
So remember now, you've got $500,000 just sitting here waiting to offset a sale. We then have Jim and Allison sell their business or their real estate,
It's the
but they get a
business.
$1 million gain. And our portfolio manager says, no, you can't take the entire $1 million and put it in the Opportunity Zone Fund. It's too big of an allocation to that single asset space um, for your portfolio and for our safety. So we're only going to put $800,000 of it in that. In year five, when the taxes are due, this couple ends up paying only $51,000 in taxes because they got to use that $500,000 tax loss that we generated in the prior strategy to offset the gains in this. So they basically save $500,000 over a 10-year period. And I say 10 years because remember that they don't ever have to pay tax on the growth of this investment. So in year five, it reduces the tax due on the sale of their asset that they had, their business or their real estate. But in year 10, it avoids taxation on the growth of this entire investment. So they save $500,000 just in that part. Then we have the 1031 exchange fund. So let's assume that they sold their real estate property for 1.5 million. They reinvest 100% of the proceeds into that exchange fund and they save another $400,000 in taxes. Okay, remember they don't pay taxes on the sale and they're generating an income of 4.5% the first 2 to 3 years and 6% thereafter. So if we look at the total benefits of our strategies, this couple saved $700,000 in taxes by employing this. Remember, that is money that would have been paid to the IRS that's now sitting in their portfolio. So what does that mean? That number compounds over time. You've invested it, it's doubling approximately every 10 years. When we look at this over the next 30 years, Jim and Allison actually are making over $4 million dollars just by employing these tax strategies.
And that is just on the tax savings as well. That's not even the overall investments. That's wonderful.
Yeah, so I don't know if you have any final thoughts to add here, Paige, but I think working together, I would just reiterate Paige understands not every CPA does these different strategies and how to report them, and not every investment advisor employs these strategies. I think you can speak to that, Paige. But
Yeah.
together, the intersection of Paige and her tax discipline and us and our investment discipline can generate millions of dollars of savings over your retirement lifetime.
Yeah, I completely agree. And Holly and I've worked together for several years now. I've seen clients of hers utilize these strategies, and it has been very beneficial for these clients, and the savings have definitely been there.
Well, thank you, Paige, for partnering with us on this endeavor. And thanks to you out there, our clients and friends, for your trust and confidence in us. It's a pleasure.
Thank you, Holly.
Bye bye.
Bye.